Hi there, Gary Orff here with Renaissance Financial to talk about the markets. Started the year on a fairly strong note in the stock market, but more recently, markets have gotten choppier. A war broke out, tensions have increased, and the focus on tariffs has come back, all of which can, understandably, make investors uneasy. On top of that, there are short-term concerns about inflationary pressures and job growth. When you put all of this together, it's no surprise we've seen more market ups and downs than usual lately. But it is important to remember that this kind of volatility is a normal part of investing in stocks. If we look back over the past several years, the S&P 500 has gone through multiple market pullbacks, some fairly significant. Yet each time the market recovered and went on to make new highs. The reason for that is simple. Over the long run, stock prices are driven by the strength of a company's earnings. And overall, corporate earnings currently remain quite healthy. In fact, company earnings grew about 13% year over year last quarter. And expectations are for similar growth to earnings for the rest of this year. That's an important and solid foundation for the stock market overall. Because of that, we wouldn't be surprised to see the market regain its footing and move higher over time. That said, headlines will continue to change from day to day. And if the conflict in Iran lasts longer than expected, we may see continued short-term volatility. You may also be hearing concerns about artificial intelligence, things like heavy spending, high valuations, or whether all companies investing in AI will really be successful. Those are fair questions. What we expect, though, is that stronger companies, especially the leaders in areas like semiconductors, infrastructure, and AI applications, should continue to benefit. And importantly, all of this investment in AI can help support economic growth and future earnings over time. Earlier this year, economists were expecting solid economic growth. That outlook has been adjusted a bit due to recent uncertainty, but the economy is still expected to grow. We're also seeing support from pro-business policies, consumer-focused legislation, and potential regulation, which could encourage more investment and business activity. When we put everything together, we remain optimistic. While market volatility can feel uncomfortable, periods like this have happened before. And historically, investors who stayed disciplined and focused on the long term have been rewarded. We believe that patience and a well thought out investment strategy remain the best approach. And we'll continue, of course, to monitor the environment and adjust as needed.